Mark Minervini of Minervini Private Access joins us on the show right now. Mark, hi, good morning. Good to have you on the show. What is your own outlook on global equities at the moment? Because U.S. equities are looking poised to hit an all-time high. How much strength do you see in this trend in the near term?
Well, I think the U.S. market and some of the global markets are getting a little bit ahead of themselves right now. So we may move higher here. We may see all-time highs in some of the indexes in the U.S. in particular. You know, the S&P's been doing great. The NASDAQ 100 all-time highs here. But I think you're seeing sentiment is very bullish now. And you're getting an opposite picture of what you had just months ago when everybody was bearish. So now everybody's bullish, and that usually leads to some type of market pullback. So in the short run, I think as we move higher here, I would probably use that for selling and sell into any strength from here and then look for a pullback to have a better entry.
Right. So are you focused on the U.S. among the developed markets at the moment? And what would be the strategy that you would advise while investing into U.S. equities?
The way I look at it is if you're going to look at the markets per se and look at indexes, for instance, whether it's the index in India or China, I would say that you want to be more investing in the individual stocks in those countries. And of course, that's probably going to have to happen through people that are in those countries, as opposed to maybe U.S. investors being able to have access to the individual stocks in some of these, foreign markets. Ultimately, we're going to end up with the world markets are probably going to open up, and we're going to be able to invest in markets around the world as easily as the U.S. someday. However, if I were in India or I were in China, I would be looking at individual stocks. And I think that's where the real advantage is, and in particular, I think there's more of an advantage or more of an opportunity in individual stocks in a country like India than there might be even in the U.S. Even though the U.S. is going to have a lot of quality growth companies, you're also going to have less efficiently priced securities in a market like India. So I think you're going to find a lot of inefficiently priced securities in India, in China. The big question is getting access to them. But of course, if you're in those countries, then you have access.
Sure. Mark, which are the most interesting stock charts that you've come across in recent times? Any particular themes that are standing out to you at the moment?
As far as the U.S. is concerned, there's lots of smaller names and mid-cap names that are good. I don't, really have a list of them right now because I've sold most of my names recently. And this recent strength, it's been mainly an index type rally where you're getting the S&P 500 and the Dow and the NASDAQ have done really good off the lows. But to meet the criteria that I'm looking for, I still think that the best buying opportunity has yet to come. But I've been in PayPal. That's been one of the better performers. Microsoft, Starbucks. These are bigger cap names. They're kind of a different type of name than you would normally hear from me. Normally, you're hearing names from me that most people haven't heard of because they're going to be smaller mid-cap names. But the ones that have been working have been the bigger names that are enjoying the rally with the popular indexes right now.
Interesting. What about valuations, Mark? How does one find, and this is the biggest question everyone has, how does one really find the right entry point to the market?
Well, as far as valuation is concerned with the overall market, if we're talking about the U.S. in particular, valuation is not really that stretched relative to interest rates and relative to looking back at the norm or the mean, the average of about 16 and a half times earnings. We're not really that stretched. The real question is, can growth keep up and continue growing the economy? That's the real, the real question here. So as far as valuation on individual names, I'm usually in names that have a higher valuation than the overall market. I'm looking for the growth, and you have to pay for that. But the overall market is not drastically overvalued here, so I wouldn't be worried about overvaluation at this point.
Okay, fair point. So just looking at the MSCI World Index versus MSCI Emerging Market Index, where do you think leadership will come in from?
Well, specific leadership, that's something that I'm not I'm not following the emerging markets that closely with the individual stocks. But I can tell you this, when you look at the MSCI All Country World Index and you look at the percentage of stocks that are or I should say the percentage of the indices in that index that are above their 200-day moving average, that recently has surged and moved up to, I don't know, maybe 80% or so. But when you look at the percentage of those indices that have their 200-day moving averages in an uptrend, you're looking at somewhere in the neighborhood of 30%. So what that means is that the indexes have moved up very rapidly, but the longer term trend hasn't really gotten a chance to now turn into that uptrend. So we're getting ahead of ourselves a little bit. And I think you'll see the same thing if you look at the US market versus, say, the NASDAQ, how many stocks are above their 200-day or have 200-day moving averages in an uptrend versus the index being above the 200-day. So that's something that I think we provided a chart for that too. You can see the difference between the percentages of indices that are above the 200-day versus how many of those indices actually have 200 days that are in an uptrend.
Okay. Recently the inverted yield curve was much spoken about and in the past has led to a recession in the US. Do you believe a recession will follow now that the yields have inverted?
Okay, so the first part is with the yield curve, as far as it being inverted, we're not clearly inverted, all right? And I would look at the Fed funds as being really the key interest rate at this point that is really what we would call the axe, if you will. That's what I'm looking at. I'm looking at Fed funds, and Fed funds would have to be, well, the range is 2.25 to 2.5%. So we use the low end of that range. So with the 10-year was to go below 2.25, you would have an inversion, Fed funds versus 10-year, or if, of course, Fed funds were to rise. I don't think that's going to happen. I don't think the interest rate, the Fed funds are moving up. And now, so we have to watch the 10-year. If the 10-year were to get well below the 2.25, then I would look at an inversion. However, your question was, does that lead to a recession? Yes, very often it does, not always, but sometimes it takes a long time for that recession. The median lead time, I believe, is somewhere between 6 and 8 months. So, and there's been periods where we've had up to 18 months before you had a recession. So once we get that inversion, I don't think we're clearly inverted yet. Not all the yield curves are inverted. The 3-month T-bill versus the 10-year, yes, that's inverted. But I don't think we have a clear-cut inversion. And I also believe that we're probably looking at a recession if that were to happen anywhere between 6 and 18 months later.
Mark, which are the preferred technical analysis tools that you use? We have so many of our viewers, as well as us, that have read your books and track your commentary. In terms of specific tools that you could leave us with today, something that we could perhaps take forward in terms of even time frame, indicators, anything you could share with us.
So when I'm looking at individual stocks, I'm not looking at a whole lot of technical indicators. I'm mainly looking at the charts themselves using bar charts. So I'm really focusing in on earnings, sales, and margins, and I'm looking at the bar charts themselves with some very basic moving averages, a 200-day moving average, a 50-day moving average. So nothing really fancy or tricky. It's just I've been doing this for I think I'm on 36 years now, 36 years looking at these charts. I've looked at millions of charts over the years, made hundreds of thousands of trades. So after, that amount of time, I'm pretty good at just, looking at a chart and understanding it. But, no indicators. I don't look at indicators. I'll tell you why I don't look at indicators. And I like looking at the charts themselves. Any indicator, let's just say it's a MACD, a stochastics, whatever it is, they're all based on the price itself. So they can only be coincident or lagging. They can't lead because they're based on the price themselves. So they can't lead the price if they're based on the price. So why would I want to focus on something that is coincident or lagging when I can focus on the object itself?
Okay, so interesting takeaway coming in there from Mark. Mark, what's the best way, according to you, to manage risk?
Well, there's really only a few ways that you're really going to effectively manage risk. I mean, you can hedge and you can buy puts against your positions, all that stuff, but that's actually adding risk. It's not taking risk off, and you're also cutting off some of your reward. So the way that I haven't found a better way in 36 years than position sizing and cutting your losses. My risk is really controlled by my position sizing, and then either through technical analysis or strictly through a percentage number or a dollar figure that I'm willing to risk, that I'm timing my trades. So, and I'm buying them in the direction of my trade. Usually the stock is moving in the direction of my trade. And if I'm not in a profit, fairly soon, or that stock starts moving against me, I'm usually going to flip out of the trade. Now, with this type of strategy, I'm wrong just as often as I'm right, but I'm managing that risk at a level that is at a fraction of what my gains are. So as long as I can turn that over and manage the risk at less than my gains, then I have a positive expectancy and an edge.
Okay. Does the US GDP growth trajectory give you confidence of being bullish in the future?
Yeah, well, the U.S. is slowing. We're definitely seeing some slowing, and usually the LEI will lead and will top before the economy goes into recession. The ECRI weekly leading index, if that's down, 4, 5, 6 weeks consecutively, that's usually a tip off that you could be heading into a recession or a slowdown. Year-over-year change on that, if it gets down, -5, -10%. As far as the global situation is concerned, the U.S. is really performing better than most of the rest of the world, and that's why we're seeing a worldwide easing effort, where we're seeing monetary policy becoming easy again. And again, I think that you're going to see a defense, from the Fed and monetary policy around the world is going to very quickly go to an easy policy, or rates will come down, and you're going to see defending these economies. So we may get a recession, but I think it's going to be relatively mild, and we're going to then reaccelerate and have a continuation of a secular bull market. I think we're in a secular bull market, and we had a cyclical downturn, and we may get a cyclical recession. But as far as the future's going here, I wouldn't be surprised if 10 years down the road we see Dow 40,000, and that's not really a big market call. That's only about 5 or 6% a year. But I wouldn't be surprised if we see 40,000 during the next decade, and world markets are much higher.
Mark, such a pleasure having you today on the show. Thank you much for taking the time out.